What's up, future millionaires? Picture this. You're 19 years old, picking up a book that completely changes how you see money forever. That's exactly what happened to Warren Buffett when he read The Intelligent Investor by Benjamin Graham. Today, I'm breaking down the book that Buffett calls by far the best book on investing ever written. And trust me, if it's good enough for the Oracle of Omaha, it's definitely worth your next 5 minutes. Let's dive in. So here's the deal. Back in 1949, this professor named Benjamin Graham dropped a book that basically said, hey, everyone's investing wrong. And young Warren Buffett was like, this guy gets it. Graham taught something revolutionary. Investing isn't gambling. It's not about hot tips from your uncle or following the crowd. It's about being smart, patient, and honestly, a little boring. But here's the thing. Boring makes bank. The book's main idea: there's a huge difference between investing and speculating. Investing is like planting a tree. You water it, take care of it, and years later, you're chilling in the shade, counting your money. Speculating? That's like betting on which way the wind will blow. Good luck with that. Okay, this is where it gets fun. Graham created this character called Mr. Market. Imagine you have a business partner who shows up at your door every single day. Some days he's super excited and wants to buy your share for way too much money. Other days, he's crying into his coffee, offering to sell you his share for pennies. Here's the genius part. You don't have to do anything. You can just ignore this emotional roller coaster of a person. But when Mr. Market gets really depressed and offers you an amazing deal, that's when smart investors like Buffett pounce. The stock market is Mr. Market. When everyone's panicking and selling, that's your shopping spree. When everyone's buying like crazy, maybe sit that one out. As Buffett says, be fearful when others are greedy, and greedy when others are fearful. This concept right here, this is the secret sauce. Margin of safety means never paying full price. Ever. Let's say you find a company worth $100. Would you pay $100 for it? Nope. You wait until Mr. Market has a bad day and offers it to you for $60 or $70. That gap, that's your margin of safety. It's like buying a Mercedes for the price of a Honda. Buffett took this idea and ran with it. He looks for companies selling at huge discounts to their real value. It's like finding designer clothes at a thrift store. You're getting quality for cheap, and that protects you if things go wrong. All right, quick timeout. If you're loving this breakdown and want to level up your investing game, you need to check out our free newsletter, The Value Investor. Every single week, we drop market commentary that actually makes sense. No confusing Wall Street jargon. Plus, once a month, we do deep dives on stocks that might be your next big winner. We're talking full analysis, the kind of stuff hedge funds pay thousands for, except it's completely free. Just head to our website, I'll drop the link below, and join thousands of smart investors who are building wealth the Buffett way. Seriously, it's free, no catch. Just good old-fashioned value investing wisdom delivered straight to your inbox. Okay, back to why Buffett loves this book so much. Graham splits investors into two types, and this is super important. You're either a defensive investor or an enterprising investor. There's no shame in either game. Defensive investors are like, set it and forget it. They want good returns without doing homework every night. Graham says, cool, just buy a mix of high-quality stocks and bonds. Today, that might mean index funds. Even Buffett says most people should just buy an S&P 500 index fund and chill. But enterprising investors, they're the nerds who actually enjoy reading annual reports for fun. They dig deeper, find better deals, and can beat the market. But here's the warning. It takes serious work. You can't be halfway. You're either all in, or you're better off being defensive. Now here's where Buffett took Graham's ideas and added his own flavor. Graham was super focused on cheap stocks, what we call cigar guts, stocks so beaten down you could get one last puff of profit. But Buffett realized something. Why buy garbage companies just because they're cheap? Instead, buy amazing companies at fair prices. He learned this partly from his partner, Charlie Munger, and it made him even richer. Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That's evolution, baby. He took his teacher's principles and made them even better. So there you have it, the book that turned a kid from Omaha into the world's greatest investor. The Intelligent Investor isn't about getting rich quick. It's about getting rich for sure. The big takeaways? Don't follow the crowd. Buy when everyone's selling. Always demand a margin of safety. And decide if you're going to be a chill defensive investor or a hardcore enterprising one. If this video helped you understand why Buffett swears by this book, smash that like button. And remember, check out the Value Investor newsletter for weekly wisdom that'll make you a smarter investor. Until